Doctors across America are using short-term rentals to slash their tax bill. This strategy has helped many physicians save tens of thousands in taxes annually. But the short-term rental market is facing unprecedented changes. The truth is, new city regulations, neighbor backlash, and insurance requirements are threatening to eliminate this tax advantage completely. Ever wonder how the tax magic actually works? It's actually pretty straightforward. Physicians who own short-term rental properties can write off expenses like maintenance, utilities, and even property management. These deductions directly offset their high income from anything that they're doing in their clinical practice. And the key is material participation. But here's the twist. As this strategy gains popularity, cities everywhere are cracking down on short-term rentals, creating a perfect storm that might sink this tax-saving lifeboat. Major cities like New York and Detroit, Atlanta have already imposed strict regulations on platforms like Airbnb. In this video, we are going to discuss the hidden truths about short-term rental properties that every high-earning professional needs to know. Last year, a doctor I know, we'll call her Dr. Smith, bought an Airbnb to save on taxes. She was promised passive income, big write-offs, and fast-track wealth. 6 months later, the short-term rental city regulations changed, and she lost $20,000. And the tax savings she expected, well, they didn't quite show up and show out like anticipated. So if you're a physician thinking about short-term rentals, then this video is for you. We're busting 5 myths so you can invest smart and skip the financial headache. Myth number 1 is depreciation is free money. I know that you all have heard about bonus depreciation, especially with the One Big Beautiful Bill Act, where Donald Trump has essentially made bonus depreciation 100% in the first year. Now, depreciation is one of the biggest short-term rental tax perks. Not only can you deduct all of the furnishings and everything that you purchase for the short-term rental property in the first year with this 100% bonus depreciation, by doing a cost segregation study, you can also deduct the wear and tear on the property, often $10,000 to $30,000 per year, to reduce your taxable income. But here's what no one tells you. When you sell the property, the IRS wants that money back. It's called depreciation recapture, and it's taxed at up to 25%. So Dr. Smith, she deducted $75,000 over 5 years and got hit with $18,000 tax bill when she sold. So if you want to avoid that surprise, there are ways to get around it. You can do a 1031 exchange to defer taxes. Basically, what that means is that when you sell the property, the capital gains and the depreciation that you use can be applied to the purchase of another property in a 1031 exchange. Or you can hold the property long term. Either way, you really want to work with a real estate professional who can help you to understand depreciation and how that's going to affect the value of your assets and your tax strategy today. Myth number 2 is short-term rentals are passive income. Short-term rentals, they're not a set it and forget it. They're a hospitality business, kind of like running a mini hotel. So think guest messages, late night emergencies, cleaning turnovers, and restocking. It's about customer service and it's constant. So when you think about how you're going to actually gain from this investment, you might consider that you have to hire a property manager so that they can help you to manage this while you're doing your main gig, doctoring. If you want to be hands-off, that can be a 20 to 25% cut on your profits. You can outsource the work, but you may lose some of the benefit of passivity as a form of income. Now, myth number 3 is short-term rentals always make more than long-term rentals. And, typically you would think that you can charge more for a short-term rental property. So you might gross $6,000 a month, but it's not about just what you gross, it's about what you keep. Short-term rental properties have some seasonality to their income and also have a higher vacancy rate. So many properties might sit empty for 30 to 40% of the time. And once you subtract cleaning and supplies, repairs, property management, taxes and insurance, and vacancy, your gross can become pennies and not profit much. So That is not predictable when you have these fluctuations in seasonality and vacancy rates. And as a physician, what you will need is a strong reserve to help you to manage the gaps. Myth number 4 is that every doctor can use the short-term rental loophole. Now let's talk about the short-term rental loophole because this is where physicians get excited. Normally, real estate losses like depreciation cannot reduce your clinical income unless you're a full-time real estate professional. But short-term rentals are different. If your average guest stay is under 7 days and you meet material participation rules, which means that you work at least 100 hours in the business and work more than anyone else in the business or on the short-term rental property, then that means that you can write off all of the losses and the depreciation against your W-2 or 1099 income. So as an example, if you earn $350,000 a year and your short-term rental produces $40,000 in expenses and depreciation, if you materially participate, your taxable income drops to $310,000. And this could equate to $10,000 to $15,000 in federal taxes. But here's the test. For material participation, you need either 500 plus hours in the year on the property or 100 plus hours and more than anyone else, or you're the only one doing the work. So for a physician, also working as a physician, you likely will need some support. I don't imagine that you're going to be in there cleaning toilets and restocking toilet paper. So you want to ensure that you can meet those material participation requirements, that you have documentation of all of the hours as well as the expenses to really capitalize on this loophole. Without this loophole, there's no tax benefit. So you definitely want to make sure that you meet the qualifications so that there is nothing that can be tested by the IRS. And myth number 5 is that short-term rentals are perfect for busy physicians. Short-term rentals can be a great tool for building wealth, but they are not for everyone. They do work if you have extra cash, if you're ready to track your hours or self-manage, if you've researched all the short-term rental regulations, if you want an active, not necessarily entirely passive, an active income stream, and you can handle the risk and the unpredictability. But they don't work if you need total passivity, if you can't log time, if you're in a tightly regulated city, if you're already stretched thin or close to burnout. Now, you can have a short-term rental to generate additional income. I'm not saying that for physicians, they don't work at all. But if you want to optimize your short-term rental, if you want to optimize the tax benefits and the returns on that investment, sometimes it requires for you to understand what the policies are in the environment that your short-term rental property is located. Now, Dr. Smith that I mentioned in the beginning, she wanted a shortcut to tax savings. And what she found is that it was a detour to some additional stress. So should physicians buy short-term rental properties? Short-term rental properties can definitely boost your income, reduce your taxes, and create real wealth, but only if the math makes sense, if the location is short-term rental friendly and you're clear on the time commitment. So before you buy, ask yourself, do I have time to materially participate? Can I afford to float the property during slow seasons? Is my expected return at least 10 to 15% cash on cash return? And do I have the right tax advisor backing me up to help me to really capitalize on this? If you are a high income earner, a healthcare professional, you have a short-term rental property that is working for you, then let us know in the comments. Give us some tips of what you love about your property and how you got started. And if you're someone who's thinking about getting started, then put that question in the comments. Let's help each other to figure out this math and ensure that we can bust some myths about short-term rental properties while increasing our wealth and building the life that we desire. Thank you for subscribing to this channel and giving this video a thumbs up. I'll see you on the next one. Bye-bye.